Hey guys, Dave Keller here with Market Misbehavior. About a month ago in early November, I posted a video on my channel called When is the S&P 500 No Longer Bullish? Well, a lot's happened in the last month, particularly in the last week, so we're going to update that video, which is linked below, with an update on that same chart. What is the S&P 500 chart telling us now? So a previous video on this channel called When is the S&P 500 No Longer Bullish? And again, there's a link below in the description. We talked about one particular chart which combined some different concepts of breadth and ratio analysis and sector performance and so forth to overall describe the conditions around the S&P 500. And we talked about some of the things that would suggest to us that the uptrend phase was over and that the market was starting to roll over. Well, the S&P's come off a pretty good amount here recently in the last week, starting the Friday after Thanksgiving, continuing on so far this week, the week after Thanksgiving. So I thought it'd be great to take that same chart and look at how the conditions have evolved. So we're going to look at that chart. Also, two other charts that sort of relate the short-term weakness with the long-term uptrend that we've seen in stocks. Before we get to the chart, though, just want to remind you, if you like this sort of thinking about technical analysis, behavioral finance, price, trend, momentum, breadth, sentiment, if all of that's of interest, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We would very much appreciate that back. Finally, put a comment below. Do you agree with the S&P 500 assessment that you're about to hear? Let me know in the comments below. Let's get to it right now. All right, so this is the same chart that we featured in our previous video. I'm going to go quickly through these different components. There are five data series that are represented on the chart. We'll go through each one of them and then talk about how the conditions have changed in the last 4 weeks or so. So the very top is the closing price of the S&P 500, or the closing value of the S&P 500. We're going back for the last 2 years or so. Below there, we have four different indicators, four different market indicators that you look at in relation to the S&P itself. The second one down is the common stock only advanced decline line. So it's looking at the New York Stock Exchange, but only common stocks, because the New York Stock Exchange has things like closed-end funds and bond funds and things that aren't really a good reflection of what the companies listed on the New York Stock Exchange are actually doing. So we only look at the common stocks, and that's the second series. The next one down in pink is the ratio, what I call the offense to defense ratio. Consumer discretionary versus consumer staples. Are investors going more to the offensive side or the defensive side of the consumer space? And it's a ratio using the equal weighted ETFs for each of those two sectors. Finally, or next to that, we have the relative performance of the S&P 500 versus the utilities sector. The utilities sector is one of the most defensive sectors out of the 11 S&P sectors. Investors only really own utilities if they are nervous and want to gain some additional income and just ride out some sort of market uncertainty. So investors rotating out of sort of the general market and into utilities in particular is a good indication that that investors are looking a little more risk off. And then at the very bottom, we have the new highs in green and the new lows in red. That's the 52-week highs and lows for the S&P 500. Let's go through each of these from the top, and we'll talk about what the conditions are telling us, where they were in early November and where they are now the first week in December. So the S&P 500 chart made a new closing high going into the end of November, indicating further upside potential. Now, all of a sudden, we started to come off a little bit. It's worth noting, though, that on a closing basis, we're still well above the October low. And that September-October pullback pulled us down to around 42.50, just above there on the S&P. So remaining above there on a closing basis certainly makes this long-term chart seem still very constructive. We pulled back a little bit, and in the short-term chart we'll look at in a second, 45.50 is a key level, which we actually broke down through today, but we'll look at how that relates to the longer-term trend. And I would say, looking at it just on a closing basis, remaining above 42.50 would maintain a bullish feel overall to this chart. That's kind of what's happened. It's been a consistent pattern of an uptrend since the March 2020 low. This is where it gets interesting. This first breadth indicator, the common stock only advanced decline line, is testing the low from September. So think about that. While the S&P is still about 200 points, 250 points above its low in late September, early October, the advanced decline line in the New York Stock Exchange is already testing that low. Now, how is that possible that the S&P is still well above that level where the advanced decline lines have come down? Well, the advanced decline line is an equal weighted measure of all those stocks listed on the New York Stock Exchange and whether or not they're going up or down on a particular day. And it keeps a running total of that change, that daily change in advances versus decliners. So if you have a series of days like we have definitely seen in the last couple of weeks, where we've seen a lot of stocks closing lower and very few closing higher, that advanced decline line is going to rotate lower. What happens a lot of times at the end of a bull market phase, you have the S&P or the major index continuing to go higher, while the breadth lines like the advanced decline lines actually start to rotate lower and break support. Usually that's a great early warning system that conditions are starting to get potentially a lot worse, because a lot of individual names are already breaking down, even though the indexes, the major indexes, are not yet reflecting that. So we are very close, and this is a real good reason to watch this chart through the course of this week to see if it's able to hold that low from September. From what I'm seeing on the individual names, I don't think that's actually going to happen, but we will see. The next one is looking at offense versus defense. And this is where overall you can see that the ratios come off here a little bit. And again, we're looking at 2 years of data, and this chart's pretty compressed, but the ratios come down quite a bit here, which tells you between consumer discretionary, which are more discretionary purchases, luxury, retail, travel, those kind of things, versus staples, which are things like alcohol, household goods, beverages, tobacco, things that you're probably going to want to get regardless of whether the conditions around you are good. You're always going to need toilet paper and potentially alcohol or tobacco, whatever else you feel like you need in your life. So this ratio is going lower, which tells you that investors are going more on the defensive side. However, it's still overall in a fairly decent trend. You'd want to see, just like the S&P and where it's at relative to its low from the last 3 months. The advanced decline line, does it hold that low? Same thing here. Do you make a new 3-month low in this ratio? We're not quite there, but we're getting there as we start to rotate lower. That's another reason to watch that chart. Finally, the relative strength in utilities. If you look at the markets on December 1st, which is when I'm recording this video, utilities were the only one of the 11 S&P sectors that actually closed in the positive, actually closed in the green for the day. All the other 11 sectors were down fairly significant, with something like communication services probably at the bottom of the list. So overall, you're starting to see some days where utilities are at the top of the list, but you're not really seeing an incredible rotation lower in this ratio. Utilities still have a lot to prove before they are showing relative strength versus other sectors. So this one, I would say, not quite yet indicating a reversal in trend. Very interesting at the bottom, the new highs and new lows. Look at how few new highs you see, new 52-week highs. Very few S&P stocks so far in the last week are making a new 52-week high. Most of them are coming off of their previous swing highs or their all-time highs. You are starting to see an increasing number of new lows. As a matter of fact, today, in this last week, you've seen the most new lows on the S&P than you've seen since March of 2020. That's the last time we've seen anywhere near over 5% of the S&P making a new 52-week low, which is what we saw actually in the last day or two. So you are starting to see an evaporation of new highs and an expansion of new lows. And I would say out of all of these things, the two that look the most concerning would be the advanced decline line, which tells you in terms of breadth, a lot of stocks are closing lower and consistently, to the point that this cumulative measure is starting to potentially break down. The second one is the evaporation in new highs and the expansion in new lows. Less new highs, more new lows. And if that trend continues, tells you more and more stocks are not just stopping going up, they're literally making new lows. And if you want to know which stocks those are, look at communication services, things like AT&T and Discovery and Viacom and Disney. These are the stocks that are, testing new lows. Maybe not 52-week lows, all of those, but very, very close. So overall, I would say this chart has gone from being wildly bullish, and in early November, when we recorded that last video, overall conditions very bullish across the board. Now, a month later, given the weakness in the last week, you're starting to see some potential signals that it's mixed at this point. And we identified some key levels that would potentially make this chart turn a little negative. I wanted to share two other charts with you just to build on what we talked about there. I think you also always have to remember as an investor to relate the short term to the long term. And this is my market trend model, and I will have to do a video dedicated just to this at some point. So I'll make a note to do that. But basically, I look at weekly data on the S&P 500, and I use exponential moving averages to look at the short-term, medium-term, and long-term trends. And these are all based on different combinations of exponential averages. And if you know stock charts, you can look on the left and see the settings I'm using to determine those three timeframes. And very quickly, last Friday, with that 2+% pullback in the S&P 500, my short-term model turned negative. It was negative last back in September, but before then, just a couple random days. The last time it's really been significantly negative was back in September, October of 2020, and February, March of 2020. So turning negative suggests a short-term pullback within a long-term uptrend. The long-term and medium-term signals are still positive for me. The medium-term model turning negative, if and when that would happen, that would be an indication that conditions are starting to significantly worsen. And that's when I tend to think much more risk off as an investor. At this point, short-term weakness, long-term strength, I'm still looking opportunistically at charts like Apple and others, home builders and semiconductors that are still doing very, very well. If my medium-term model turns below zero, that's when I start to think a lot more defensively. Finally, I would just highlight the daily chart of the S&P 500. Right now, we just broke through the 50-day moving average, and I think that's important. 45.50 is the high from September. We broke out of there in October. We've now retested those levels from above. We closed below the 50-day moving average, which means it's all about confirmation. You see a further validation by a further move to the downside below today's low, which is around 45.10 or so. 10% below all-time highs would take us down just below 4,300, which is the low from September and October, also the 200-day moving average. So if we do validate a break of the 50-day, I see downside of the 4,300, at which point I would reevaluate things. So overall, that is how the picture has changed a lot in the last 4 weeks. So there you go. That's the chart we looked at in early November, updated for the last 4 weeks of trading. And you can see how the conditions have really changed, particularly on that tactical time frame, that short term, from being overwhelmingly bullish and sort of long and strong up and to the right to starting to show some signs of weakness. I would say, as always, it's always important to differentiate the short-term patterns with the long-term patterns. That market trend model that I shared with you shows you how, while the short-term model still has turned negative, the medium-term and long-term trends are still overall very positive. The S&P is just testing its 50-day moving average today. Holding that would certainly be a very bullish sign, but breaking that tells you to think a little more about potential downside. And for me, I'm seeing 4,300 as a potential downside target here in the short term. What do you think? Do you agree with that assessment about the S&P and how the conditions have started to rotate lower? Are you optimistic or pessimistic about the S&P from here? Let me know in the comments below. Also, give the video a like if you appreciate it. We would very much appreciate that back. And if you enjoy this sort of thinking about investor decision-making behavior using the power of behavioral finance and technical analysis, if that's of interest, I hope you'll subscribe to my channel. It'd be great to have you along this journey. For everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you soon.